they bring the money to the settlement. So for example, if you're buying property for 500,000 and you're borrowing 400,000 and you're eligible for the grant, the bank will say, well, we're bringing along 400,000, that's the amount that you're borrowing, and it will also bring the grant. So they're going to turn up with 407, roughly. Now, mind you, they'll take their costs out of that, but just to make the math easy, they're going to give you the $400,000 loan plus the 7,000 for the grant.
So if you get pre-approval on your finance and you've got your first home loan grant, how long is that valid for?
Pre-approvals will normally stay valid for 3 months.
Okay.
First homeowners grant, a lot of times we'll do that once you've got your contract. So we know that you're eligible for the grant. We won't actually do the forms at the pre-approval, but as soon as you've got your contract, a lot of people say, well, what should I do now? Well, now you've got your pre-approval, you can go and find a house. Once you've found a house, we need a copy of the contract, and we also need to do the grant.
I'm just thinking, like with the, like with everything that's been going on in the last week or so, we might have done all this 2 weeks ago, but nobody's going house hunting at the moment because it's just everything's over there. So oh well, what are we going to do? That's all right. We've got 3 months, so don't worry. But you don't want to not look and then lose all that sort of stuff. You know what I mean? Yeah, absolutely. So we'll keep it as part of the file anyway. So it's not something that you normally have to worry about. A good broker will definitely be in control of that and make sure that it's all done at the time of the loan. Because a lot of times when, as a broker, putting the loans together for the banks, we put it in the story. Every good loan has a good story. Some stories are better than others. And as part of that story, it'll be whether or not you're eligible for the grant. It's part of the story of the loan. So having said that, every good loan has a good story. Some stories are better than others. Some have some difficulties. Some you have to be creative, let's say. Banks hate risk. So any time we find a risk, we need to try and find a mitigant for that risk. Now that might be, people say, well, I've only been in my job for 3 months. Yeah, but I was in my last job for 6 years. So that's a mitigant. Right? I've only had this deposit for the last 4 months. Yeah, but I haven't spent any. I've been adding to it for the last 4 months. So there's always ways to try and reduce any risk as far as the bank's concerned. Bank is a 4-letter word. Risk is a 4-letter word. Always 4-letter words. The banks just try and stay away from them. They've got no sense of humour. And even worse than the banks as far as sense of humour is mortgage insurers, which we'll cover that in a second. But before I do that, I wanted to get on to savings. So one of the things that banks want to see, and more the mortgage insurers than it is the banks, that you've got some dirt money, what they call skin in the game. Mortgage insurers call it blood money. Their thinking is that if you've had a gift of funds for deposit and you've got the grant, then you've really got no buy-in. So that if it all got too hard, you go, oh, here's a piece, I don't want to do it, it's too hard. And they go, we don't want your house, we just want your loan. So the banks and the mortgage insurers together will want to see that you've suffered some pain, sweated some blood to actually get into your own place. Because then they figure that you're less likely, if it gets hard, to bail. So what they measure for that is what they call genuine savings. And genuine savings for them consists of 5% of the purchase price. So a $300,000 home, that's 15 grand. So they want to see that you've got 15 grand of your own money to put towards the deal. Now, what they will also look at with that is where did that money come from and how long have you had it? So basically they want to see that you've saved it up. That's what they like. So to demonstrate that, they'll normally want the last 3 months of your bank account to show here was the money 3 months ago, here's the money today. Is there at least 5% of the purchase price that you've either accumulated or held for that 3-month period? Now that could be money in the bank, can be shares, can be a term deposit, can be a number of things that are not so liquid as cash, but it can't be gift, it can't be sale of an asset. Oh, I sold my car, I got 30 grand for it. I'm going to use that, that's my deposit. That's not savings, that's sale of an asset. Now, as a general rule of thumb, the banks will want you to have some savings. There are lenders who will let you get away with what they call borrower's contribution. So they'll say 5% in. Where did you get it from? Don't care, just prove that you've got it. As long as it's a contribution. Now that could have been a gift, could have been sale of an asset, could have been tax return or share dividend or something like that.
So if you've got 5% that you've saved or held over a period of 3 months, gives you more choice. Because there's only a couple of banks that will let you do 5% from any source. Right? But if you've got 5% savings, then you've got more choice. And ideally you want to be in a position where no matter which bank we take you to, they're all fighting each other to have your business. You don't want to be in a position where, please Mr. Bank, can I please have a loan, and you've got 1 or 2 banks that you can choose from. You want to be in a position where you've got 10 banks to choose from, and you're calling the shots. You can pick interest rate, you can pick product, not having what they'll give you. So we like to try and get our clients into a position where you're in control, not the banks in control. Banks are falling over. So with your things like statements and stuff like that, don't be a chucker, be a keeper. So when you get your bank statements, don't look at, oh yeah, that's good, I've got my bank statement, chuck it out. Keep it. Keep everything. Keep all the paper. All your pay slips, all your bank statements, all your credit card statements, just keep everything. At least until the home loan stuff's all put to bed. And if you want to chuck it out or shred it after that, fantastic. But a lot of times the banks go, well, we need the last 3 months history on your bank account. People say, well, I chucked it out. You have to go
What
and
do
get
you
it
do
again.
about electronic statements?
Electronic statements? All
I
well
don't
and good.
have any statements. I have all mine electronic.
Yeah, and usually you can print those off.
But a lot of
Yeah.
places won't accept them.
Yes, true. Most online accounts or online transaction histories, when you get the transaction history, it's got the account number and it's got all the history.
This thing
That's no good because it's got no name on it as to who it belongs to.
But even I had to produce a bank statement not that long ago,
Yeah.
and even had, you know, like it's ING. So
Yeah.
it's got ING on the bottom.
Yeah. Yeah.
They wouldn't accept it.
Yeah. Because it doesn't have any details. What the banks want to see is name,
I
address,
had my name on the
account
top.
number, and then the statement. So they will accept online statements, but you usually need at least one original. And then you can get the originals, got your name and personal name on it, and the account number, and then you can marry that up to the online account, and then that's acceptable. But basically just keep everything. So that you've got your statements and stuff, don't change that. So 5% is an important figure. The next important figure is 10%. So 5% is your minimum. 10% gives you more flexibility. Since the GFC, a lot of the banks that used to accept a 5% deposit now say you need 10% deposit. So if you've got 10% deposit, that opens up more banks again. Some banks, for example Westpac. Westpac say, look, if you're new to Westpac, it's 10% deposit. But if you've got an account with Westpac, then we'll let you have 5% deposit. So if you're already a Westpac customer, you can get away with less deposit. Commonwealth Bank's the same. St George is the same. So there's a few that do that. So if it's, I guess with who you're banking with now, sometimes people say, look, I like my bank. Some people say, I hate my bank. But it's a good idea to get a bit of a heads up onto what banks will accept, what deposits, those sorts of things. So it's why it's good to get your pre-approval done up front, because you can sort of work out, there's my best option, what's the minimum deposit I'm going to need, what's going to give me the most flexibility. St George have started to open up some of their policy where they're doing things like, if you currently pay rent, then they'll accept the rent that you've been paying as savings. And you've still got to come up with the money ultimately, but they can go, instead of having to show a bank account where your bank account's been going up and up and up, you go, well, I'm paying $400 a week rent. Doesn't that count? St George go, yep, that counts. But if you're new to bank, you need 10% deposit. If you're already with St George, you can get away with 5. So a few different things to watch out for. But keep your statements. One of the other things that's around, there's a lot of jargon. You've got one of these in your packs, which is just I guess it's a cheat's guide to jargon. You'll hear lots of jargon in the lending industry and to do with banks. Things like LVR. Does anyone know what LVR stands for? No takers? One? Yeah, we've got later. It stands for loan to value ratio. So it's pretty straightforward when you hear the term. How much is the loan compared to the value of the property? So this is the 90%, 95%, 80%, stuff like that. Contract of sale. So when you're doing a contract. AST, approved subject to. So that's when you get your pre-approval. Yes, it's approved, subject to these conditions. And it's things like valuations and stuff like that. Now, in most cases, the banks will organise that. You don't have to do that. The banks or your broker will organise it. but it's still a requirement for the bank. I'm not going to go through all this because we're here all night. It's just something that's handy to have in your pack. Now, a lot of it, some of it's done through the bank, some of it's done through the solicitors. Some of it you only hear mentioned at real estate agents, but we've tried to cover off as many as we can. The other thing I was going to mention was mortgage insurance. A lot of misconception about mortgage insurance. People think, well, if that means that if something happens to me, my loan gets paid out. No, that's mortgage protection. Mortgage insurance is a risk coverage for the bank. Once upon a time, the banks would only ever lend you 80%. You had to have a 20% deposit. And the reason that they worked on 80% was they figured if something happened and they had to sell you off, they'd have to sell it in a hurry at a discount to get their money back. So they figured they'd only get 80% of whatever the house was worth. So you had to have 20% deposit. A lot of people couldn't get houses because they didn't have 20%. Even today, if everyone had 20%, a lot of people wouldn't be able to do it. Anyway, along came mortgage insurance. Actually, its real name is Lender's Mortgage Insurance, LMI. There's a jargon. Lender's Mortgage Insurance. It's a once-off premium that the borrower pays at the beginning of the loan, lasts for the life of the loan. You never pay it again. But what it is the banks still work on the 80% rule. If something happened and they had to sell you up, they had to sell it in a hurry, they only get 80% of its value, then they call on the mortgage insurance to cover any shortfall, so the banks can't lose. That's why it's called Lender's Mortgage Insurance, because it covers the lender. So if you're borrowing higher than 80% of the value of the property, so in other words, if you've got less than 20% deposit, you're going to be in the land of mortgage insurance. Now there's a few exceptions to that rule, but basically that's the rule of thumb. Less than 20% deposit, you're going to pay mortgage insurance. How much is that? It's on a sliding scale and it depends on how much you borrow. So if you've got a 15% deposit, you're borrowing 85%, it's something like 0.6% of the loan amount. If you're borrowing 90% and you've got a 10% deposit, it's something like 0.12% of the loan amount. If you're borrowing 95%, and so you've got 5% deposit, it's something like 2% of the loan amount. So it's a sliding scale. It gets dearer the less deposit that you have. There's a higher risk for the bank. And it also gets dearer depending on how much you borrow. So they've got tiers, 0 to 300,000, 300 to 500, 500 to 750, above 750. So if you're borrowing 95% lend on a $500,000 property, then you're going to be up there in the mortgage insurance stakes. Guesstimate, $12,000. Now, most of the banks will let you add that to the loan, what they call capitalise it. So if you're borrowing 400,000 and the mortgage insurance is $8 grand, they let you borrow 408. So they cover the premium. So in reality, instead of you borrowing 90%, you're borrowing 92 or 91.5 because they actually allow you to put the premium onto the loan. You're then paying interest on that premium for the next 30 years, but in reality, the loan doesn't last 30 years anyway. The average life of a loan is only 7. Doesn't mean that that's the life of the debt. Most people's debt lasts way longer than 7. But on average, any given loan only lasts 7 years.